Welcome to Ultimate Learning Hub, platform developed to ensure we have affordable, quality, universal, transformative learning experience. In our today's session, it's a continuation of preparation of sole traders accounts. In our previous session, we had already looked at how to prepare sole traders accounts. In other words, what is the introduction to sole trader accounts. So in this session, we want to focus on an example of preparation of sole traders accounts. So we have an example with us that will enable us know how to prepare the profit and loss accounts for a sole trader, and also how to prepare the statement of financial position for a sole trader. So having a complete understanding of this session will enable us know how to prepare accounts of a sole trader. So let's look at example 1. The following trial balance was extracted from the ledger of Stephen Chi, a sole trader, as at 31st May 20X1, the end of his financial year. So a financial year that ends on 31st May 20X1, that financial year therefore starts in June 20X0. So it starts on 1st June 20X0 for it to end on 31st May 20X1. So Stephen Chi's trial balance as at 31st May 20X1, property at cost, equipment at cost, accumulated depreciation as at the beginning of the year. So which means we'll have to calculate depreciation for the year on property and on equipment. So we have our purchases, we have our sales, we have inventory as at 1st June, we have discounts received, return outwards, wages and salaries, irrecoverable debts, loan interest, other operating expenses, trade payables, trade receivables, cash in hand, bank drawings, allowance for receivables, 17% long-term loan, and we also have capital as at 1st June 20X0. So we are being told further, the following additional information as at 31st May 20X1 is available. A, inventory as at the close of business has been valued at a cost of $42,000. Wages and salaries need to be accrued by 800. Other operating expenses are prepaid by 300. The allowance for receivables is to be adjusted so that it is 2% of trade receivables. Next, depreciation for the year ended 31st May 20X1 has still to be provided for as follows. Number 1, property is depreciated at 1.5% per annum using straight line method, and equipment at 25% per annum using reducing balance method. Required, prepare Stephen Chi's statement of profit or loss for the year ended 31st May 20X1 and his statement of financial position as at that date. So in our starting point, we'll start by preparing the first account that we have been asked. Solution. So the name of the person is, sorry, let me just create some space for calculations. I'll slightly try to increase the platform. So we are being told, prepare Stephen Chi's statement of profit or loss for the year ended at 1st May. So Stephen Chi statement of profit or loss for the year ended 31st May 20X1. So that is our statement, 31st May 20X1. Okay, so we'll be preparing this statement as a 31st, and we were working in dollars. Our currency of operation is dollars. So let me maybe push this. Okay. So in order to prepare a statement of profit or loss, we always start with sales. We identify what is our sales from the question. So our sales should be a credit entry in the trial balance. So our sales is 402,200. 402,200. So that is sales that has been given in the question. Now we check if there is any sales returns inwards. So let's check for return inwards. Is there any? There is return outwards. Okay, return. There is no return inwards. So because there is no return inwards, next we go and get the components of cost of sales. Now in cost of sales, so under cost of sales, we normally start with opening inventory. So what is our opening inventory? Inventory as at 1st June 20x0 is 50,000. So our opening inventory is 50,000. Next, after that inventory, we normally add purchases. We check for purchases. Purchases is 250,000. 250,000. And then we check if there is any return. There is return outwards, which is purchase returns. So we have, in this case, return outwards 15,000. So you less purchase returns, return outwards, return outwards. And we are saying return outwards is 15,000. Now, after that, you come and less closing stock. If there is any carriage inwards, you add it to the purchases. But this question did not have any carriage inwards. So you come and less closing inventory. In most cases, it's normally provided in the additional information. So additional information 1, inventory as at the close of the business has been valued at 42,000. So this is valued at 42,000. So what is our cost of sales? Our cost of sales is opening inventory. You add purchases, you less return outwards, and you also less closing inventory. So what we get is 243,000 as our cost of sales. Now, sales less cost of sales gives you gross profit. So our gross profit is therefore equals to 402,200, you less 243,000. So it gives us a gross profit of 159,200. Now, to the gross profit, you add other sources of income. Like, for example, if there is any discount received, which I can see there is a discount received, in this case of 4,800. So add discount received. Discount received. So discount received is 4,800. Also, we look for provisions for bad and doubtful debts. If you find there is a decrease in provision for bad and doubtful debts, you add it. Let's try. If we find it's a decrease, you add it to the gross profit. If it's an increase, you add it to the expenses. I'm repeating, you check on provisions for bad debts. If you find that bad and doubtful debts, if you find, or allowance, you can call it allowance for bad and doubtful debts. If you find it's an increase, it's an expense. If you find it's a decrease, it becomes an income. So we will add if there is decrease in allowance for receivables. Okay. Now let's check allowance for receivables in the TB, in the trial balance is 500. So we compare 500, which is the opening allowance, to maybe additional information. Look at here in the additional information, the allowance for receivables. So remember, opening allowance is 500, and you are being told closing allowance for receivables is to be adjusted to 2%. of trade receivables. So our trade receivables, it's 2% of trade receivables. Let's check for the receivables. Receivables is 38,000. So if we take 2% times 2% times 38,000, what it gives us is 760. So it's not an increase, it's a decrease. So it's a decrease. So it's an increase rather. It's moving from 500 to 760. So it's an increase. It's not a decrease. So if it was a decrease, we could have added it there. It's an increase. So this total gives us 159,200 plus 4,800. So it gives us 164. And then we can now come and add expenses. Account for all expenses. So what are our expenses in this question? So you list it according to the order of the trial balance so that you don't leave out any expense. So property is not an expense, purchases. So which means accumulated depreciation. So which means there is an expense on depreciation if we follow this order of the trial balance. So there is the depreciation on property and there is the depreciation on equipment. So depreciation on property. So depreciation on property, in this case, we are being told additional information E. Depreciation for the year ended at 1st May has still to be provided as follows. Property 1.5% per annum using straight line. Property is 1.5% per annum using straight line. So 1.5%, property's cost is 120,000. So this will be 1.5% times 120,000. Okay, so that gives you 1.5% times 120,000. So it gives you 1,800. We also have depreciation on equipment. Depreciation on equipment. Now, depreciation on equipment, we were being told equipment is 25% per annum using reducing balance method. So using reducing balance method is 25% per annum. So what you'll do, you'll take 25% times into bracket, reducing balance, you take 80,000 minus the previous accumulated depreciation of equipment. Reducing balance, the cost minus accumulated depreciation, that is what you get the percentage. So 80,000 minus 38,000. 38,000. Okay, we have that. So that gives us, it gives us 25% times into bracket 80,000 minus 38,000. So we get that. So we are done with an expense called depreciation. So let's go down the trial balance. Sales, inventory, discount received, return outwards, wages and salaries is our next expense. Wages and salaries. Now, we have wages and salaries of 58,800. Now we go to the additional information and we check if there was any prepayments or accruals. So let's go to additional information 2B. Wages and salaries need to be accrued by 800. So any accruals increases the amount of expenses because we are following accruals concept. We should be recognizing the expenses when they have been incurred, but not when they have been paid. So it means in this case, the wages and salaries paid was this for 58,800, but there was an amount accrued which was not paid of 800. So you will take 58,800, 58,800 to it you add the amount that was accrued of 800. So that will give you the amount of wages and salaries. So 58,800 plus 800. So it gives you 59,600. 59,600. Next expense is irrecoverable debts. Debts or bad debts. So our bad debts or recoverable debts is 4,600. 4,600. Still, when we are on bad debts, we found that there was a increase in provision for bad debts. Increase in allowance for receivables. Increase in allowance for receivables. We found that the opening allowance for receivable was 500 and the closing, so it was moving from 500 to 760. How did we get 760? It's moving from 500 to 760. How did we get 760? 760 was 2% times, was it 38? Trade receivables was 38,000. 38,000. We had done it earlier when we were looking at what you add to the gross profit. So it's moving from 500 to let's just try it, 2% times 38,000 so that we confirm. So 760, so 760. So 500 to 760. So that's an increment of 760 minus 500. So it's an increment of 260. So if it was a decrease, you add it to gross profit. If it's an increase, it's an expense. So let's move on. Loan interest is our next expense. Loan interest. So our loan interest is 5,100. 5,100. Next, we have, after the loan interest, we have other operating expenses. Other operating expenses. So for the other operating expenses, we have 17,700, but there is a note 3C. Other operating expenses are prepaid by 300. So which means the operating expenses of 17,700 included an amount that was overpaid, prepayment paid in advance. Prepayment, so the amount that was paid in advance, you remove it because it does not relate to this period. It relates to the next period. So 17,700 minus 300. So that gives you 17,400 as a prepayment. We check if there is any other expense, drawings, allowance, capital, and wages, inventory. So we have exhausted all the expenses. So let's come and now we have exhausted all expenses that we need. So what is our total of the expenses? So we have a total of 99,260. And that gives us therefore profit for the year So profit for the year is 64,740. Profit for the year. In other words, let me call it net profit. So our profit for the year is 64. Now, that's how we prepare statement of profit and loss for a sole trader. So that's statement of profit and loss for a sole trader. So if we move on to the next part, the next part therefore asks you to prepare a statement of financial position for the same sole trader. So statement of financial position for the sole trader. So I'll bring it down here, but it is now statement of financial position as at 31st May 20x1. So in this case, we note we were working in dollars. Now, we normally start with non-current assets. Non-current assets. We list the cost of the non-current asset. We look at the accumulated depreciation of the non-current asset. And we also look at the net book value of the non-current asset. So that is what we look at in each accumulated depreciation. So we pick the cost minus accumulated depreciation to give you the net book value. So in this case, we'll start with property. Property. Now, what's our property at cost? 120,000. We have 120,000. Now, what was the accumulated depreciation brought forward? 20,000. And depreciation for property for the year was 1,800. So we have accumulated depreciation is therefore 20,000 plus 1,800. So that is the total accumulated depreciation. So our net book value will be the cost minus accumulated depreciation. So it gives us 98,200. Next, we go to equipment. Now, in our equipment, the cost of equipment is 80,000. And accumulated depreciation is, the depreciation brought forward is, accumulated depreciation is 38,000 plus 10,500. So 38,000 plus 10,500. So it gives you 48,500. So that will be 80,000 minus 48,500. It gives you 31,500. So those were our only non-current assets in this question. So non-current assets is therefore 129,700. 129,700. So that is total non-current assets. Well, now, once you have looked at non-current assets, you now go and list all your current assets. Current assets are normally listed in the order of the liquidity, from the least liquid to the most liquid. So the least liquid asset is inventory. And then we look for receivables. We look for cash, the prepayments, prepaid expenses, prepaid, what was prepaid? Prepaid operating expenses. Okay, prepaid operating expenses. Was there cash? Yes, there was cash in bank. So there is bank. In the order of and cash in hand, finally. Cash in hand. So let's start with inventory. Our inventory is 42,000. And then receivables. Okay. Our receivables is, trade receivables was 38,000. But remember, there was an allowance at the end of the year. The allowance at the end of the year was 2%. Sorry, yes, 2%. 2% because it was an increase times 38,000. So it's equals to 38,000 minus the 760. So 2% was 760 times 38,000. So it gives you 37,240. Prepaid operating expenses was 300. Bank was Bank was 19,300. And cash in hand was 300. So I believe we have captured all current assets. So our total of the current assets is 99,140. And therefore you take the non-current assets plus our current assets. So that gives you 228,000 as our total assets. So our total assets is 228. Now, once you are done with the total assets, you go to capital and liabilities. In other words, financed by capital and liabilities. Financed by. So I'll start with capital. Or let me just call it equity. But okay, equity. Equity is residual interest from the assets of the business after deducting liabilities. So our equity, it includes capital. And capital at the beginning of the year was, capital was 121,300. 121,300. And then remember, in a sole trader, we said the owner can reduce the capital by having drawings. Can reduce the capital by having drawings. So this is allowed in a sole trader. So the drawings were 24,000. 24,000. It reduces the amount of capital. And then profit for the profit, retained earnings. First of all, we check in the trial balance if there was any retained earnings. Was there any retained earnings brought forward? None. So there was no retained earnings brought forward. So because there was no retained earnings brought forward, we just add profit for the year. We can just still call it retained earnings. So our retained earnings, profit for the year, it was 64,740. And then if there is any revaluations, there was no revaluation. So we have total equity. Okay, so our total equity is equals to capital minus drawings plus retained profits. So it gives you 162,40. So 162,40. And then after that, we go to non-current liabilities. Non-current liabilities. So in our non-current liabilities, we check if there was any loan. 17% long-term loan of 30,000. 17% long-term loan. 17% long-term loan of 30,000. So if it's only one non-current liability, you just post it in the last column. Okay, unless there is any long-term loan, non-current liability. Okay, so we've accounted for that. Next, we go to current liabilities finally. Current liabilities. So in our current liabilities, we start with trade payables. Our trade payables are 36,000. 36,000. We had accrued expenses, accrued wages and salaries. Wages and salaries. Our accrued wages and salaries was 800. 800. Wages and salaries was 800. Let's check if there is any maybe proposed dividends. Of course, this is a sole trader. So this is 36 plus 800. Maybe we check if there was any bank overdraft. Not there. So 36,800. And therefore, we can have total equity and liabilities. Total equity and liabilities. So we have equity plus non-current liability plus current liability. It gives you 228,840. So it has balanced. It has balanced. So total assets should be equal. So total assets should be equal to total equity and liabilities. Should be equal to total equity and liabilities. And that is how statement of financial position of a sole trader is prepared. Statement of financial position. So we have therefore looked at how we prepare the income statement or the statement of profit or loss, and also how we prepare the statement of financial position. That brings us to the end of preparation of sole trader accounts. Maybe in another session, we can create another session to look at example 2, so that we have at least 2 examples on how we can prepare sole trader accounts. Thank you for your attendance of this session, and that brings us to the end of sole trader accounts. Let's meet for our next session. Thank you.